Welcome to Chapter 14 Fund Operations. Up to this point, we have spent a great deal of time on the visible parts of a mutual fund: investment strategy, performance, fees, distribution, and retirement use. This chapter moves behind the curtain: a fund's promise of daily liquidity, accurate ownership, and one reliable NAV is manufactured through a network of accounting systems, custodians, transfer agents, pricing services, brokers, administrators, intermediaries, and control teams. The portfolio manager can make a brilliant investment decision, but investors can still receive the wrong result. If a trade disappears, a bond is mispriced, an expense is not accrued, or the share count is wrong. We will trace the daily NAV cycle, distinguish custody from fund accounting, examine fair value and NAV errors, and then connect T+1 settlement, cyber resilience, vendor oversight, and incident response. This is the part of finance where boring is a compliment. When operations works, almost nobody notices. When it fails, everybody suddenly develops a passionate interest in reconciliation. The shareholder sees one price and one account balance. Operations sees a deadline and a crowd of inputs that all have to agree. Every security must be captured and valued. Cash, receivables, liabilities, income, expenses, corporate actions, and shares outstanding must be complete. Purchases and redemptions must be time-stamped and posted to the correct class. The fund accountant, custodian, advisor, transfer agent, brokers, pricing vendors, and intermediaries all contribute pieces of evidence. Most covered United States securities now settle on T+1. So yesterday's unresolved break has less time to become today's settled position. Regulation SP also raises the operational stakes around customer information incidents, including service provider notice as soon as possible and no later than 72 hours after discovery of an applicable breach. The point is not that every function happens in one room. The point is that one fund remains accountable for the combined result. A great portfolio can still fail investors through a bad NAV, a broken trade, lost data, or an inaccurate shareholder record. Operations is invisible until a decimal point goes freelance. Then the supposedly boring department becomes the most popular meeting on the calendar. This chapter develops 4 practical skills. First, trace the operating cycles. You should be able to follow trades, positions, cash, valuation, shareholder activity, and NAV from source data through reconciliation and sign-off. Second, calculate and explain. That includes the mechanics of an NAV error, daily expense accruals, fair value inputs, shares outstanding, and the economics of correcting affected transactions. Third, differentiate responsibilities. Fund accounting, custody, transfer agency, administration, and intermediary record keeping are related, but they are not interchangeable. Knowing who owns which record is essential when two systems disagree. Fourth, control the process. You should be able to apply reconciliation, exception management, vendor oversight, incident response, cybersecurity, business continuity, and escalation principles to a realistic event. Notice the sequence. Trace what happened, calculate the effect, bondee, identify the responsible books and parties, and then decide what control or remediation is required. By the end, operations should look less like a vocabulary list and more like a chain of evidence, ownership, timing, and escalation. In this chapter, the question, who knew what and when, is not drama. It is a control framework. 4 connected questions organize the module. First, what is happening in the portfolio book? That book contains trades, positions, income, expenses, corporate actions, valuation, cash, and the NAV calculation. Second, what is happening in the shareholder book? That includes accounts, purchases, redemptions, exchanges, distributions, tax reporting, and service activity. Third, how does the fund connect to the market? Brokers, custodians, depositories and settlement systems, collateral, and cash movement translate investment decisions into delivered assets and money. Fourth, what protects the entire process? Reconciliation, tolerance reports, approvals, exception management, cybersecurity, vendor oversight, incident response, and board reporting form the control environment. These questions connect through capital activity. When shareholders buy or redeem, the share count and cash must flow between the shareholder and portfolio books. When a trade settles, market records and custody records must agree with the accounting ledger. When they do not, the difference must be explained, not merely admired from a distance. The two books are not supposed to be independent novels. They are different chapters of the same financial story. The operating model uses segregation of duties to create independent evidence. The investment advisor authorizes trades, manages cash and risk, and provides portfolio and valuation inputs. The fund accountant maintains the official investment ledger, accrues income and expenses, applies prices, and calculates class level NAV. The custodian safeguards assets, supports settlement, and maintains an independent cash and position record. The transfer agent maintains registered shareholder accounts and processes purchases, redemptions, exchanges, and distributions. The administrator coordinates financial reporting, regulatory filings, budgets, governance, and service provider oversight. Intermediaries and vendors may maintain omnibus records, supply prices, transmit orders, and provide data. This structure reduces the danger of one party controlling every record, but it also creates more handoffs. A break between systems is not automatically an error. One book may reflect trade date while another reflects settlement date, or one system may be waiting on a corporate action. The control requirement is to identify the reason, support it with evidence, and resolve it on time. Outsourcing changes who performs the task. It does not teleport responsibility into another dimension. The fund and its board still need an oversight process. The daily NAV cycle has 6 stages, although several run in parallel. First, capture the data, trades, positions, cash, income, expenses, corporate actions, foreign exchange rates, and shareholder activity. Second, reconcile independent records, compare the accounting book with the custodian, brokers, transfer agent, and internal trade systems. Third, value the portfolio using market quotations, evaluated prices, exchange rates, and approved fair value methods. Fourth, accrue income and liabilities, management fees, service costs, taxes, interest, dividends, and receivables belong in the ledger even when cash has not moved. Fifth, calculate net assets and divide by the correct shares outstanding for every class. Finally, review. Run tolerance reports. Compare the NAV movement with market and portfolio expectations. Investigate exceptions, obtain approval, publish the result, and preserve the evidence. A checklist helps, but a checked box is not an explanation. Strong review asks why the NAV moved, why a price changed, why cash differs, and why a break remains open. The final sign-off should mean that material exceptions have been understood, not that everyone has grown tired of discussing them. Midnight is a deadline, not a control philosophy. Fund accounting is repetitive because the same categories recur every day, and judgment intensive because the details rarely arrive in perfect form. Trade accounting records purchases, sales, principal, interest, commissions, settlement, and realized gain or loss. Income and accrual accounting recognizes dividends, coupons, amortization, expenses, waivers, and receivables on the correct schedule. Corporate actions introduce splits, mergers, tenders, calls, conversions, rights, spin-offs, and reorganizations, often with incomplete or changing information. Multi-class accounting allocates common and class-specific expenses and capital activity correctly. Financial reporting turns the ledger into schedules, tax records, audits, regulatory filings, and board materials. Exception controls compare the current day with prior days, identify stale prices, flag unusual NAV movement, and require documented sign-off. The key idea is completeness. A perfectly accurate entry cannot compensate for a trade that never reached the ledger. A correct price cannot repair an incorrect share count. Accounting is quiet until a corporate action arrives in 3 versions, 2 currencies, and 1 email marked urgent. The job is to turn that noise into one auditable record without improvising away the controls. Custody and fund accounting look similar because both maintain records of securities and cash, but their purposes differ. The custodian safeguards or controls assets through depositories and sub-custodians, receives and delivers securities and cash at settlement, collects income and corporate action proceeds, and provides statements and confirmations. The fund accountant maintains the official ledger for portfolio activity, receivables, liabilities, income, expenses, capital, valuation, NAV, and financial reporting. The custodian may show what has settled and is held. The accounting book may also include unsettled trades, accrued income, expenses, and fair value adjustments. That means differences can be legitimate. A sale executed today may remain in a settlement receivable while the custodian still shows the security. A foreign dividend may be recorded before cash is collected. The control is reconciliation. Identify the difference, classify its timing or cause, support it, assign an owner, and close it. Forcing the two systems to match without understanding the reason can erase useful evidence. A matched balance is reassuring. An explained difference is essential. 2 computers agreeing is not proof of truth, and it may simply mean they received the same bad file with admirable consistency. An NAV error is not just a bad number, it reallocates value among buyers, sellers, and continuing shareholders. The formula on the slide defines the per share error as reported NAV minus correct NAV. Suppose the correct price was $20, but the fund published $19.96. The error is negative 4 cents per share, or 20 basis points relative to the correct NAV. A $100,000 buyer would receive about 5,010.02 shares instead of exactly 5,000. Those extra shares represent about $200.40 at the correct price. A redeeming shareholder would receive 4 cents too little for every share sold. The fund must identify the cause, reconstruct the correct books, determine every affected class and date, analyze purchases, redemptions, exchanges, fees, and reports, and apply the approved correction policy. The question is who received too much, who received too little, and who ultimately funded the difference. Then comes communication, reimbursement where required, and root cause remediation. Correcting the spreadsheet is the beginning. It is not the closing ceremony. The error report must separate the initiating mistake from the detective controls that also failed. Fair value becomes important when a market quotation is unavailable or no longer reliable. A thinly traded bond, a security in a foreign market that closed hours earlier, or an instrument affected by new information may require more than copying yesterday's price. Rule 2. A5 organizes the process. The fund identifies material valuation risks, selects appropriate methodologies, defines inputs and assumptions, calibrates and backtests results, oversees pricing services, reports to the board, and retains evidence. But a pricing vendor can be valuable, but the vendor is an input, not an oracle. Operations and valuation teams need procedures for challenging a price, comparing sources, reviewing overrides, and escalating material differences. Consistency matters, but consistency does not mean refusing to respond when circumstances change. The strongest value is not necessarily the number with the most decimal places. It is the value produced by an authorized, transparent, repeatable, and challenged process. In finance, a clean-looking number can hide a messy assumption. Fair value governance forces the fund to show its work, especially on the evening when the easy price is unavailable and the deadline is behaving as if nothing unusual happened. A fund's critical process often depends on systems and firms it does not directly operate. Cybersecurity must protect identities, instructions, customer information, data, and access. Incident response must contain the event, investigate scope, preserve evidence, make decisions, communicate, and remediate. Service provider oversight requires due diligence, contracts, notice requirements, monitoring, testing, and realistic alternatives. Business continuity must consider any unavailable sites, staff, utilities, telecom, markets, vendors, and entire regions. Data governance identifies the authoritative source, data lineage, access rights retention, quality checks, and change control. Manual workarounds need their own approvals, maker-checker controls, capacity limits, and reconciliation. The danger is that a workaround can keep the fund open while quietly bypassing the controls that make the fund trustworthy. Regulation, SP, reinforces that the extended enterprise matters, including service provider notice around applicable customer information incidents. Outsourcing can improve scale and expertise, but it also creates concentration and dependency risk. A backup plan that has never been tested is not a backup plan. It is optimistic literature. Resilience means knowing which processes are critical, how long they can be unavailable, who has authority, and how the fund returns to a controlled state. For many portfolio managers, 4 o'clock is the end of the trading day. For fund operations, it is closer to the opening bell. Orders reach their cutoff. Pricing files begin to arrive. Foreign exchange rates, evaluated bond prices, corporate actions, and late trade details must be loaded and challenged. Around 6 o'clock, price collection may still be underway. By roughly 8, NAV review and exception resolution may be intense. Publication may follow around 9, and downstream files can continue toward 11. These times are illustrative, not universal, but the direction is clear. The decision window shrinks as downstream deadlines approach. T+1 settlement adds pressure because trade confirmation, allocation, affirmation, cash planning, and break resolution must happen sooner. A complex fund with foreign assets, derivatives, thinly traded securities, or a late pricing event has even less room. Speed does not remove the need for evidence. It makes prioritization and escalation more important. The team needs predefined materiality thresholds, backup sources, clear decision rights, and the ability to distinguish an issue that can be documented and monitored from one that blocks publication. At 4 p.m., the market closes. Operations begins asking why 17 files disagree. Fund operations has modernized in waves. In the 1970s, depositories and automated processing reduced the movement of paper certificates. In the 1980s, standardized fund networking helped scale intermediary orders and account data. In 2017, United States settlement moved from T+3 to T+2. Rule 2 of 5 modernized fair value governance in 2020. In 2024, T+1 accelerated settlement again, while Regulation SP amendments strengthened customer information incident requirements. Through 2025 and 2026, reporting and structured data expectations continue to increase. The overall direction is more speed, more transparency, and more technology. That is progress, but it changes the risk profile. Manual keying risk can decline while model risk, access risk, vendor concentration, cyber risk, and interface risk grow. We replace couriers with application programming interfaces. The interfaces take fewer lunch breaks, but their failure modes can be considerably more creative. Automation should therefore include ownership, testing, change control, monitoring, recovery, and data lineage. A process is not modern simply because it is fast. It is modern when speed is paired with evidence and resilience. It is 5:45 in the evening. A pricing vendor outage has removed evaluated bond prices and foreign exchange rates for 18% of the portfolio. The normal backup feed covers only half of those positions. Markets are closed, and several intermediaries expect NAV files within 2 hours. The wrong responses are at opposite extremes. Blindly carry stale prices or improvise a brand new model because the clock looks impatient. Start with triage. Quantify the affected assets, classes, valuation sensitivity, available data, stale inputs, and downstream deadlines. Next, use approved methods. That may include backup vendors, broker indications, models, indices, matrix pricing, observable transactions, or other evidence permitted by the fund's procedures. Governance must be explicit. Valuation, operations, legal, compliance, technology, and executive teams need clear decision rights and an escalation record. The goal is not to publish on time at any cost. It is to produce a good faith value through authorized methods, document the judgment, and communicate realistic operational consequences. After publication, compare later prices, evaluate any NAV error, reconcile downstream files, review the vendor contract, and test the contingency plan. At 5:45, the pricing vendor is down is not a sentence that improves with repetition. A resilient team turns the sentence into a controlled decision process. The risk matrix separates likelihood from potential shareholder impact. Routine cash breaks may occur relatively often and usually have limited impact when daily controls detect and resolve them. Late corporate actions, small NAV errors, and trade settlement fails can move across the matrix depending on size, frequency, and how long they remain undetected. Cyber breaches and critical vendor outages may occur less often, but they can affect multiple funds, accounts, deadlines, and data sets at once. The control response should match the risk. High-frequency, lower-impact events need efficient workflows, trend reporting, ownership, and root cause reduction. Lower frequency, high-impact events need scenario analysis, contractual protections, backups, decision authority, communication plans, and tested recovery. Near misses matter because they reveal control weakness without waiting for shareholder harm. The matrix should be updated with actual incident data, loss data, volumes, recovery time, and control performance, rather than relying on memory. A risk labeled unlikely can become comfortable furniture in a committee deck. The point of the matrix is to allocate prevention, detection, contingency, and escalation resources before the event chooses the agenda for you. The first minutes of an operational incident should follow a rehearsed structure. First, stabilize. Protect assets, systems, data, and people. Stop the event from spreading and preserve evidence. Second, scope. Identify the funds, classes, accounts, dates, providers, transactions, deadlines, and data affected. Third, decide. Apply approved valuation and AV error, cyber, business continuity, legal, and notification procedures. Fourth, communicate. Coordinate management, the board, service providers, auditors, intermediaries, regulators, and shareholders as required. Communication should be accurate and authorized. The first 10 minutes are a poor time for creative writing. Fifth, remediate. Correct books, transactions. disclosures, reimbursements, access, and downstream data. Finally, learn. Perform root cause analysis, assign actions, test completion, update risk assessments, and verify that the preventive and detective controls actually improved. A response that contains the event is good. A control environment that prevents recurrence is stronger. The playbook should be practiced before the crisis, because an incident is not the ideal moment to discover that 3 departments all believed someone else had authority to make the decision. Now apply the operating framework. A portfolio manager sold $40 million of a thinly traded bond, but the trade never reached the accounting system. The custodian has not settled it, the old position remains in the fund ledger, and the evaluated price falls 3% before the error is found the next morning. The broker confirms that the trade was executed as instructed, and subscriptions and redemptions occurred after the NAV was published. Start with the timeline. On trade date, the accounting book should remove or reduce the bond position according to the executed sale, record the sale proceeds as a receivable until settlement, and recognize the appropriate realized gain or loss. If the old $40 million position is incorrectly retained through a 3% price decline, the first pass valuation difference could be about $1.2 million. That is not yet the exact NAV error. We still need the execution price, accrued interest, settlement terms, fund size, shares outstanding, class allocations, and the precise valuation times. Next, identify who may be harmed: purchasers, redeemers, continuing shareholders, or more than one group. Then separate the initiating failure from every detective failure. Why did trade transmission fail? Why did affirmation, broker comparison, custodian reconciliation, position reconciliation, and NAV review not catch it? Finally, define remediation. Correct the books, reconstruct NAV, analyze affected transactions, reimburse as required, notify the appropriate parties, repair the interface, and strengthen exception monitoring. Pause the video and prepare one calculation, one risk, one recommendation, and one additional fact you need. Pause the video and answer all 4 questions before continuing. Question 1 asks for the fund accountant's central daily output. The correct answer is the fund's official books and NAV. The fund accountant is not forecasting markets or setting broker commissions. The role is to turn investment and capital activity into an accurate ledger and per share value. Question 2 asks why accounting records are reconciled to the custodian. The correct answer is to identify and explain differences in positions, cash, income, and transactions. The purpose is not to force 2 systems to look identical. It is to detect incomplete, duplicate, late, or incorrect activity and distinguish legitimate timing differences from errors. Question 3 asks what T+1 means. The correct answer is settlement. 1 business day after trade date for covered transactions. It is a settlement standard, not a fund class, valuation frequency, or tax rule. Question 4 asks what should happen after an operational incident. The correct answer is contain or stabilize, scope, decide, communicate, remediate, and learn. Deleting evidence, waiting for complaints, or changing the benchmark would make a difficult meeting considerably more memorable, but not more successful. Review any answer you missed and explain the operating logic. In operations, the correct answer is usually the one that preserves evidence, assigns responsibility, and protects equal treatment among shareholders. Carry 6 claims forward. First, operations delivers the product. Daily liquidity, accurate NAV, ownership records, and reporting are manufactured through controls. Second, Independent books require reconciliation. Advisor, custodian, accountant, transfer agent, and intermediary records must agree or be explained. Third, valuation is governed judgment. Methods, data, challenge, testing, documentation, and board oversight support good faith values. Fourth, NAV errors reallocate value. Correction requires reconstructing the price, scope, transactions, harm, and reimbursement rather than merely replacing one number. Fifth, speed raises the control bar. T+1, nightly files and more frequent reporting reduce the time available to solve exceptions. Sixth, the extended enterprise matters. Cybersecurity, vendors, data lineage, contracts, incident response, and continuity are core fund risks, not technology. Side notes. Operations is successful when nobody notices and educational when everybody does. The professional objective is not to eliminate every break. It is to detect, explain, escalate, and resolve material exceptions before they become unequal treatment or loss of trust. Chapter 15 carries this operating lens into exchange-traded funds, where one portfolio interacts with both an exchange market and a creation-redemption market. This final page is the refresh register for Chapter 14. Posen and Hamisher provide the operating architecture. Rule 2 of 5 supports the modern fair value framework. The Securities and Exchange Commission's T+1 materials explain the compressed settlement environment. Regulation SP amendments frame customer information safeguards and incident obligations. Tailored shareholder report and NPORT and NCEN materials connect operations to current reporting expectations. DTCC materials describe important mutual fund processing infrastructure, and Investment Company Institute data provide industry context. Do not read the long web addresses aloud. Instead, notice what each source can establish. Rules and official guidance define required process and responsibility. Infrastructure materials explain how data and transactions move. Industry statistics describe scale. None of those sources proves that a specific price, a reconciliation, workaround, or incident decision was correct. That conclusion requires the fund's own evidence, approved procedures, data, materiality analysis, and documented judgment. The durable operating questions are simple to state. What is the authoritative record? What changed? Who owns the exception? Which shareholders may be affected? What deadline matters? What evidence supports the decision? And what prevents recurrence? Chapter 15 now adds the ETF's two-market structure, where the ticker may look simple while the operating plumbing becomes even more interesting.